Good morning or good afternoon, traders. Today is Friday, December 19th, 2025. This is You've Got Options for Income Navigator. Today, I'd like to go over positions that I have on other than the short SPY put campaign and the hedged income trade. I have a few positions on. These are either covered strangles, wheel, some sort of parts of wheel. There's a leftover jade lizard. I like to call all of these trades together as part of my triple income trade, right? I'm selling puts, I'm selling calls, I'm collecting dividends where I can, or I'm selling in the money puts to replicate covered calls. But all in all, my goal with these trades is to collect premium from short puts, right? That's income one, short calls, that's income two. If I'm long the underlying, I get the dividends, that's potential income three, and then potentially getting called away from that long position, realizing a capital gain. That's another source of income. So, all in all, I think it's safe to call this trade a triple income trade, or TIT if you want to get cute with it. Um, there's also a few positions on. These are bear traps. So we have one that is on your screen right now. This is SPX, a regular bear trap, where instead of concentrating all of our potential profit somewhere out of the money, we kind of spread that concentration over a wider range. This trade has been on for 8 days. As you can see, the underlying, which is SPX, didn't do a whole lot in the last 8 days. We moved down about a 0.05 standard deviation. So it's safe to say that, we were down, now we're back up. We're pretty much where we started this trade, but 8 days have gone by and volatility has come out of the market. And now this trade is showing an unrealized profit of around 5.5% return on risk, risk being the margin that is tied up in this trade. Now, if your goal is to make 3%, 2%, whatever per month, you're holding this trade for 8 days and you're seeing an unrealized profit of 5.5 or 5.7% on risk. You have to think for yourself. And this is what we teach. We teach you to think for yourself, do what is best for you. If that's enough, you take it off. Maybe you reposition. This trade still has 42 days until expiration. We can hold longer, but we always want to think about, if I hold longer, what are the risks and what are the benefits, right, that we get for holding on to that risk. So the risk is, in this trade, both up and down. There's more risk on the downside than there's risk on the upside, because we have the widths of these spreads are not the same, right? We have less of a width on the short call spread to the upside. And you can see that right now we are net negative, slightly negative, really not a whole lot, but we turned slight negative net delta. So if you are bullish, if you think the market has legs and we're going to continue to push higher, maybe this isn't the best trade to hold. If you think the market's going to go up, but not by much, then we're going to return back into some sort of range. If you're not expecting anything major over the next couple of weeks, which I think I'm in that camp right now, I don't think that there is enough out there to make the market absolutely explode, especially in the last couple of weeks of the year. Typically, this is quiet time, right? Most of the trading is done for the most part. Maybe there are a few others that are still chasing performance for this year, but I don't think, and I could be wrong, but I don't think that we're going to see an explosive move higher unless there's some headline that we currently don't know about. So I think I might hold on to this trade a little bit longer. One potential adjustment I would make, if I wasn't too comfortable sitting on a slightly negative delta, and this negative delta is going to increase as a function of short gamma. As you can see, if the underlying continues to rise, you can see that my delta goes from 0.3 to about 0.9. It's going to triple, so to speak, if we tag 6,900 to the upside. But it's still right. Being short one delta in SPX on a one lot is really not that big a deal. If you are trading size, I would consider possibly doing something like rolling maybe the 70.55. I would roll it up 5 points, and this is what this would look like. Right, we would remove more of the upside risk. See, the green line is the proposed risk graph at expiration. The two lines, the blue line and the green line, the blue line is T plus 0. That's our P&L line today. And the green line is the proposed or adjusted T plus 0 line. And you can see our net delta goes from negative 0.3 to positive 0.3, right? So we'll actually benefit a little bit more if the market continues, or SPX is the underlying, if SPX continues higher by rolling the short 70.55 up to 70.60, right? This would cost us a small debit, right? What that means is that we would increase our downside risk by about $130. We would take away about $130 worth of potential profit inside of this profit area. But in exchange for that, right, increasing risk to the downside, decreasing risk potential inside of this profit area, those are all negatives. The positive is, right, the trade-off is that we get to remove a big chunk of our upside risk. Our upside risk goes from about $550 to about $185, right? So there's always the give me's and the gotchas. So we're going to potentially remove some of the upside risk in exchange for taking a little bit more potential profit inside the trap or inside of the profit area, and we're going to add a little bit more risk to the downside, and we get to rebalance our net directional exposure. I don't think this is something that needs to be done today, but if you're starting to get concerned about further upside, then this is definitely one adjustment that I would consider. Let's scoot over to our January 16th bear trap, right? So this is the OG, or this is the original bear trap that we introduced some years back. And as you can see, all of our profit potential is concentrated currently out of the money, right? So if the market continues higher, our risk is non-existent to the upside. There is no risk. We took a net credit of $200 when we put this trade on, and that is the most we can possibly make if the underlying continues higher and the trap is going to expire, right? All of these options are going to expire out of the money. If we are somewhere inside of this trap, yes, there is a pretty decent bonus, right? So not only are we going to make the initial credit, we also have a potential to make upwards of an additional $1,000. This is a 10-point wide put debit spread. So if we're inside of this trap at expiration, we have a $1,000 profit that's coming from this put debit spread that will be in the money, plus the original credit of $200. So inside of the trap, we have a potential to make upwards of $1,200. Right. So, I mean, we can look at implied probability of us being somewhere inside of this trap, and just to kind of quick and dirty, the way to look at it is you can look at the delta of the long leg, which is at 67.70. It's currently delta 35. So there's about a 35% probability that we're going to be somewhere below 67.75 at expiration. Right. So it's about a 35% probability. There's 28 days left until expiration. The best case scenario for this trade, if we go forward, this is the beginning of next year, right? So if we go up or if we just kind of drift higher and then we get a slow, controlled pullback, not a crash, but a pullback towards the trap in the beginning of next year, right? We'll look at about January 13th, right? This is 25 days from now. If we pull into this trap, this trade is going to do really, really well. If the market just continues higher, obviously we don't need to worry about it. We don't have any risk to the upside. The most we can possibly make is the original $200 credit that we took in. All right, so I'm going to leave both alone. As I said before, I will try to put these on every 2 weeks. So we have put this on 14 days ago. Now there are 28 days left until expiration. I would go out and look at an expiration with 42 days, right? This gets me into another tranche of this bear trap. And, the way I think about this is that what do I have going on, right, between these bear traps? So I have one, which is without any risk to the upside. I have 0.74 positive delta. And these are just one lots, right? Obviously, if you have 8 lots here and then 5 lots somewhere else, you kind of want to understand your net directional exposure and where risk lives. So if I was to combine these two trades that I have going on right now, right, I have net positive delta, not a big delta, but right, and I don't really have any risk at expiration, unless the market moves to the tune of about 4.5% or so. So this is a fairly neutral net position. If I was to add another position, would I want to add a position with positive, negative, or neutral delta? That's the question that I have to answer for me, right? Your case may be different, so you have to do what is best for you. I think that adding another bear trap with no upside risk would benefit my net position, right? Because I'm a little concerned, right, that if the market continues higher, that this trade will go from being, a pretty decent profitable trade to potentially losing a lot of this unrealized profits. And instead of closing out this trade, if I have to add something, then I'm going to go and choose to put on the trade that has net positive delta and does not have any risk to the upside. Right? So what's going to happen is if the market does pull back, right, the trade that I'm going to set up with no upside risk and I'm going to shift all of my risk to the downside, that trade isn't going to do well. However, this bear trap is going to potentially benefit from a pullback, and so will my other trade, right? It'll do just okay as long as we don't crash, right? None of these trades are going to do well if we have a massive move to the downside. We're not planning for that. We're just thinking about if we move within what is currently being expected. So let's go ahead and try to set up a trade. This is going to be the typical 42 days until expiration bear trap, where we are looking for a 50-point wide put credit spread that pays us about $4 total credit. So let me just get rid of some things here so that it'll be easier to see. And as I always say, let's start with options that are around delta 15 or so. I know that volatility is relatively low right now, so there's a good chance that we may have to move a little bit closer to at the money, and it's always a risk. So if we were to sell a 6,500 put and then buy a put 50 points lower, this would put us at 6,450. Right, so this is a 50 wide that pays 475. We're looking for a credit of around 4. Can we take 475? Yes. Can we take 480? Yes. If we wanted to trade a little bit farther out of the money, right, this would lower our credit but give us a little bit more room to the downside. That's the trade-off. Which one is right? Which one is wrong? They're both fine, in my opinion, right? Why four? Why not six? It's totally up to you, right? I structure these trades in a way that I collect a $4 or close to it, a $4 credit to the downside, and then I spend about half of that to buy a 10-point wide put debit spread, which leaves me with a net credit of about $200. Right? I collect $4 for the put credit spread. I spend $2 on the put debit spread. I end up with a net credit of the tail profit of about $200. It's very simple, right? So let's just work with this 6,500, 6,450. As I always say, that I like to trade around these round numbers, not because there's anything magical about them. They're just a little bit more liquidity around these round numbers. We can look at maybe moving these about 25 points lower. So from 6,500 down to 6,475, just to see what the price difference or what the credit difference is. And that's not bad either, right? If we just shift everything down 25 points, we're still getting about a $4.35, maybe $4.40 credit. So that's not bad. And again, we're shifting things from 6,500 to 6,475, and I still like these the round numbers around 65, 64, 6,300, the halves, right, which are 6,450, 6,350, or the quarters, 6,475, 6,425. If you just look at the option chain in your brokerage and you look at the open interest around these round halves or quarters, you will see that there's always a little bit more open interest around those numbers. So I think that it'll be a little bit easier to get a fill. I don't want to hear the SPX options are not liquid and blah, blah. They are liquid. If you are setting up your trade and you're asking for a reasonable credit, you should get a fill. You should get a fill. Let's remember, we go to the market. The market doesn't come to us. We are not the market makers. So if we go to the market and we see a mid price, let's say 440, and you don't get a fill, it's not because there is no liquidity. It's because in order for the other side to take your action, they have to have a little edge. So you will either have to give up a nickel or a dime, or you will have to sit there and wait for the market to move in order for you to get the other side of this trade interested enough to give you the business. Joe says, any particular day of the week when you open these trades? I look at these trades at anytime, Wednesday, Thursday, Friday. On a Friday, it just works out that the expiration that I'm looking at has 42 days. I talked about this before. 42 days. If we divide 42 days into 14-day cycles, we get exactly 3 cycles. So if I put on this trade every 14 days on a Friday with 42 days to go, I will eventually end up with 3 trades in my campaign. And as one is going to roll off, another one is going to be put on, right? So one comes off, one is entered. So I'll always have 3 trades spaced exactly 14 days apart, and those 3 trades are going to be part of the campaign or cycle of this trade. So let's just stick with 64.75, 64.25. We're seeing about $4.40 credit, and then we can scroll up, and we're going to look for a 10-point wide put debit spread that's going to cost us about $2. Let's see if we can do something around 67.70. So if we buy one at 67.70, we'll sell one at 67.60. Right? It cost a little bit too much because from 440 we get down to 170. We're spending too much on this debit spread. Perhaps we need to go a little bit farther out of the money, as we know that options that are farther out of the money, they cost less. right? So let's see if we move farther out. So now we're at about $1.95. That's pretty close. $1.90. Can we take 190? Yes. Do we have to get $2? We don't, right? This is just the guideline. We're trying to get to as close to $2 as possible. If I wanted to get to $2 or more, that means I need to either increase the credit for the put credit spread, or I need to decrease the debit for the put debit spread. How do I do that? Either move my put credit spread closer at the money or make it wider, or move my put debit spread farther out of the money or cut the width. So right now we're seeing about $1.95. You know what I'm going to do? I am going to, and we're probably not going to get a fill for $2, but I'm going to put this in my Thinkorswim, and I'm going to hang this order for $2 credit. Probably won't get filled right away, and that's fine. We would get filled if the market was to push a little bit lower today, or if volatility was to tick up just a little bit. I am seeing a $2 credit mid price. I'm going to go in at 2. Let's see if they fill. If they don't, it's fine. Right, so we're looking at January 30th. These are weekly options with 42 days. $2 credit. Let me put this in. So we were collecting $2 credit. Our margin for this trade is $3,800. All right, I put this on and there is no fill. I'm just going to let it hang out. If it fills, great. I'll post this on Discord. If it doesn't fill, what's going to happen is I'm probably going to have to either move some strikes around to where I get $2 credit or higher, or I would just need to come back at the next trading day, this will be a Monday, and use the same exact process that I just described to potentially set up the same exact or similar looking trade and see if I get filled there. Or my other option is if I'm not getting a fill for $2, I see the mid price is currently going for somewhere around 190, maybe 195. There's definitely no fill at 2. So what I would do is I would just let it hang out. And if I don't want to move anything around and I just want to stay with these strikes, but I want to be in this trade, then again, I'm not getting a no fill because SPX options are not liquid. I'm getting in, or I'm trying to get in at the price where market makers see no edge and they don't want to give me this trade, right? Doesn't make them bad, doesn't make them anything. What this means is I either need to lower my asking price from $2 to $1.95, maybe go down to $1.90, or if I don't want to do that, I need to become a market maker, go out there and wait for somebody to come to me. So either we go to them and look at, what price we could get filled, give up a nickel or a dime here and there just to get in, or we need to increase our risk, either moving our put spread closer at the money or moving our put debit spread farther out of the money. So I'm going to let it hang out. We'll see what happens. Let's now go over some of the positions that I have on, part of the triple income trades. We have a couple of troubled children and these positions that have been on. I don't necessarily think they are too terrible. Otherwise, I would have cut them. But nonetheless, we are going to look at. So this is a TLT position that's been on for over a year, just over a year. 500 shares were assigned on a short put. I've collected dividends all along the way while selling covered strangles, willing to buy more shares at a lower price or sell the long stock position at a above cost base levels. So far, this trade is it's probably one of it has been one of easiest trades to manage. All you have to do is just come back, look at your short options, figure out what you're doing. Either you're taking more stock, you're rolling, or just rolling out for more credit. It's pretty much as simple as that. Eventually, when this position gets called away, right, it'll reset and we'll go back into initiating a short put, looking to get assigned. Once get assigned, sell a covered strangle around the long stock position and rinse and repeat until we get called away once again. I also have another TLT position that is currently going, and this is what it looks like. So this one has 12 days until expiration. Our short 89 put is in the money, which means that over the next 12 days, we could potentially get assigned. And if we look at extrinsic value, there's not a lot of extrinsic value, so there's a pretty good chance we could potentially get assigned on this short put over the weekend or sometime next week. What we can do, right? What we can do, if we do not want to get assigned, right, and collect the dividends that TLT is currently paying out. I don't think TLT is paying out a, let me just double check. I think last I looked at it was 3.7% or something like that. I'm just going to take a quick look to see what is the current yield. I'm not sure if this is accurate, but the indication of a yield for TLT right now is 4.7%. I don't think that is right. I think the actual yield is about 3.81% or something like that. So if you don't want to take assignment on TLT and hold shares, you can use the capital that you would have used to buy the stock. You can buy T-bills with it. You'll get 99% of that buying power back, and then you can use that buying power to deal with an in-the-money short put, which is the exact same risk graph as if you were holding long stock, short, out-of-the-money call, or a covered call. This is a synthetic covered call position. So if I didn't want to get assigned here, I would rather hold treasuries with the money, with the $8,900. I would hold the treasuries, and instead I would use the buying power that I get back. I would go out to somewhere, 30 days, 35 days, doesn't really make a difference, and sell another in the money put, which looks exactly like a short covered call, right? I would collect a small credit on this roll, collect another $20 from this roll, plus whatever treasuries would pay me. So it's not a terrible idea. Or to keep things simple, we can just let the short put get assigned. We would know our cost basis, and then once assigned, next step is to sell a covered call, and potentially, if you are planning for it, sell another out-of-the-money put to potentially buy more TLT at a lower price and improve cost basis that way, right? And the reason why I bring up the idea of rolling an in-the-money put, because if we're going to get assigned on short 89 put, right, our cost basis is 87.70 or so, and then we're going to go out and sell a covered call. Why go through all of that where we can just deal with an in-the-money put, and for the dividend that we would be missing, right, to replace the dividend that we couldn't qualify for because we wouldn't hold long shares, we can just go out and buy treasuries with the settled capital that we would have otherwise used to buy the shares. Hopefully this makes sense. I mean, I talk about this all the time, so if this is your first time hearing about this and it's going over your head, it's not a problem. We'll most definitely talk a lot more about this. So either way you're going to do this, I think it works. I'll hold it until next week. If it gets assigned, it's not wrong to replace long stock short call with an in-the-money put, or to avoid all of that, we can just roll out this in-the-money put, and we're still going to be in the same exact position, right? So that's TLT. We have ETHA. This is You hang on, let me back up a second. Rich says, how do you buy treasuries? I buy treasuries at auction, right? If you whatever you use for your broker, I use Charles Schwab. You go on their website, you go and look at their fixed income. I look at new issues only, right? Or you can buy treasuries that are already out there. I look at new issues and I buy them either 4 weeks or 8 week T-bills. Whatever your time frame is, you can do that. If it's still not clear, I will create a thread on Discord and we can talk about treasuries and the whys and hows and all that stuff so that we don't spend any of this time here today. This is the replacement for Ethereum, as you can see, over the past couple of months, right? This one has been in a pretty strong downtrend, and it is what it is. We chose to sell a 34 strike naked put, which was at the money at the time. Right, this was 77 days ago. Since then, the underlying has moved down about, just over 1 standard deviations lower. We are in a downtrend. And then I added another tranche at 22 strike. That 22 strike was going to expire worthless. So what I did was I consolidated 2 tranches into one and rolled it to a 30 strike. So now we have 28 days to go. I also sold a call at the same 30 strike just to bring in a little bit more credit. I'm not so much concerned about the upside risk. Am I concerned about more downside here? Look, if you don't think Ethereum is going to be higher, right, over long periods of time, then this is not the trade to be in. You need to understand where your max allowable loss per trade is and get out at that point. But I think that I'd be willing to hold on to this for quite some time and potentially scale in to this trade to reduce my cost basis. Right now, my break-even point is at around 25.80 or so. So sure, this position is at a drawdown, but I don't think this is too much trouble here. I'll hold it longer. And if we continue in a downtrend and if Ethereum goes to zero, that's going to suck. But I don't think that is the case for this ETF. Another position, and I talked about CRWV. We looked at the chart. We looked at what they have as a business, fundamentally what they have going on and what challenges they are facing, and kind of I shared my thoughts about what this company might do over the next 6 to 12 months. However, right, this trade right now is at a drawdown. We have 2 lots, right? We're short 105. We've rolled this one quite a bit over the last 70 days. Again, we're not down a ton, even though it might feel like we're down a lot, but we're down just about 1.2 standard deviations when we took this trade. So sure, we have exceeded what was being priced in at the time, but this one, if you want to call it a crash, I don't think it's a crash. It's definitely a pretty strong downtrend. We're now testing and we're trying to hold above the 8 and 21 EMA, which is positive near term, right? Maybe this downtrend is going to start to turn, but we're also facing a downward sloping 50-day simple moving average, which could potentially act as resistance. I think this trade just needs time. If something in the fundamentals or the story that this company has, something is going to change, then obviously this trade is going to need to get cut. But for right now, I think it's fine. So we'll just hold a little bit longer. Altria, right? So this is another one of those that has a pretty decent dividend, which is, in my opinion, is pretty safe. Looking for their current yield, and it is around 7%. Their next payment is in January 9th. We were already assigned 100 shares. I'm also selling a covered strangle around those 100 shares. What that means is I'm willing to buy more of this stock at 57.5. We have 28 days until expiration, or I'd be willing to sell the shares that I was assigned at 60. Right? So either I'm buying lower or I'm selling higher. In the meantime, I'm going to guess that I'm going to get the next dividend that they're going to pay, unless whoever is long this call is going to panic, fat finger, and exercise this call and get me out of this position before expiration. I don't think that there is that risk right now. Well, actually, let's look at the risk. What is the risk here, right? I'm short the 60 call. There is 22 cents of extrinsic value that is in this call. Why would someone give up this 22 cents of extrinsic value and exercise this call? Well, let's have a look at what is their dividend that they're going to pay. They're going to pay $1.06. So now, yes, that risk of getting early assignment is real, right? If somebody wants to grab that $1.06 dividend and potentially give up the 22 cents of extrinsic value, it wouldn't be a terrible thing on their part, right? But I don't think that this is going to happen over this weekend. So we'll see what happens over the next week or so. But as this 60 call that is short is decaying and the extrinsic value is disappearing, the odds are going to start to increase for somebody who'd be willing to give up the extrinsic value in exchange to getting that dividend. And again, that dividend is coming up on, they're going ex-dividend on Friday the 26th. That's next week. So by next week, if we don't get exercise on that 60 call, then the risk of getting early assignment goes away. For now, I think this position is fine. We are at a drawdown. No big deal. I think collecting dividends will help us reduce cost basis. And if both the out of the money put and out of the money call expire worthless, we'll sell another covered strangle, collect more income from the short put and the short call, effectively moving our downside break even further down. So that's the plan for, and this is a textbook wheel. Well, I guess this is slightly different from a wheel because we were put stock and now we're scaling into more wheel, right? So we're selling more puts out of the money to potentially buy more shares, and then we're selling a call to bring in more credit and reduce our cost basis. So this is a wheel, but I guess you can call this a modified wheel where we're scaling into this trade in the way of covered strangles. So that's Altria. We have a couple of trades that we kind of need to figure out what our options are. We have one that is XLF, right? This is the financials ETF. We've been in this for 53 days. It's currently sitting with a short put at 53 strike with 12 days until expiration, and it's trading for 10 cents. If you want to wait for the last $10 here for the next 12 days, totally fine. I would probably make the case why it would make sense to close it, right? But if we close it, what do we want to do? Do we want to just close and walk away, or do we want to keep this trade going, right? We can look at the chart. It had a pretty strong breakout above 54, 55. So now we're holding at around 55 level. I think it makes sense. I really like the idea, not because I'm bearish financials or I just think it makes more sense to go slightly delta neutral, maybe very small positive delta. So if I was to close this, and again, rolling is nothing more than closing out one trade and opening a new trade, right? If you talk to anybody in the accounting, they're going to tell you that you're going to realize either loss or gain and you're going to reestablish a new position. In your head, you may be rolling and delaying something, but in reality, rolling is nothing more than closing one trade and opening another trade. So we can call this rolling, or we can just buy to close this 53 put, realize a pretty decent gain, and then go out maybe 35 days. And we need to check liquidity. Some of these ETFs don't have a ton of liquidity in their out of the money options, but I would be looking at maybe selling a 57, and the number of contracts obviously is completely up to you. 57, 52, right? I'm trying to stay with credits being somewhat equal. So if I'm selling puts for 28 or 27 cents, I'm going to look to sell the calls at around the same price. And actually, because of the normal equity skew, right, we get net negative delta to start. And this is what this trade would look like. Or to make it easier, right, because it shows, this big fat profit. So this sometimes gives you this false sense of security, right? So let me get rid of this. Let's assume this is going to be a completely new trade. And we can treat this as such, right? This is a new trade. This is what it looks like. This darker gray area is what is currently being priced in, right? Based on current implied volatility for XLF over the next 35 days. If we put this trade on, we start off net negative delta. So you kind of want to look at the chart and do you want to be net negative delta? We're just now testing the 8-day. Can we see a further pullback? Maybe. We're not super overbought, so there may be more room to the upside. Maybe we're just kind of consolidating and building out a bull flag pattern here. So if getting net short to start this trade is not the right idea, maybe instead of selling 5 short calls, we'll only sell 3 short calls. Right now we start with net positive delta. So if this works better for you, that's fine. You may want to add more short calls if we are in fact going to break out of this bull flag and continue higher to maybe 56 or 57. Right, we get to 57, maybe you add more, or you will then consider closing out the 57 calls, which would be at the money at the time, and then rolling up and out from three contracts to 5 contracts for even money or maybe slight credit. Right, so that's kind of the idea. So again, you've got options here. You can either start off with short 5 or short whatever number, equal number of contracts on both sides. So this will be a short strangle. Or if you want to adjust your delta without shifting your strikes much, you can look at maybe selling 4 calls and 5 puts. This gets you right close to flat or delta neutral. It's not a terrible idea, right? But then you say to yourself, all right, and then what? What if we go to 57? What do I do? What if we go down to 52? What do I do? Where's your stop? What's your max allowable loss per trade in dollar terms? You can look at it in percentages terms, right? You may say, hey, my max allowable loss is 2% of my account on any given trade. Great. What does that mean in dollar terms? Is it $1,000 per trade? Is it $5,000 a trade? Let's say it's $1,000 a trade. Okay, no problem. Where's my stop here? Well, maybe if the puts get tested, right, we're obviously moving way outside of what is being currently priced in, that means volatility is increasing, right? The underlying is becoming more volatile. This trade is net short Vega, right? So assumption here on volatility is to short volatility. We're expecting a range. If we're trading and moving outside what was being priced in, odds are our assumption on volatility is wrong, and we need to, instead of try to fight and try to figure out adjustments just to protect our ego to potentially be right, we'll just use a stop loss. Where is your stop? Well, let's look. If we are going to lose maybe the 50-day SMA, that's our stop. Where's that 50 SMA right now? It's at around 53. Okay, so my stop is 53. If we do test 53, what am I down? About $160. Okay, what is my max allowable loss per trade in dollar terms? It's $1,000. Okay, we divide $1,000 by about 160, right? Because that's what our loss at 53 would be. We divide $1,000 by 160 and we get 6.25. That means my max size for this trade is 6 contracts. If we're going to honor our trade and stop out at 53, right? Did I do that right, or did I completely screw up this math? I did screw up this math. We need to increase. So on a 5 lot, let me back up for a second. Let's start with 1 lot, and then we can do the multiplication. On the 1 lot, if we get to 53, right, we're down $30. No, it's a small trade. This is not an expensive or not a really high-priced underlying. So if we stop out at 53, we're out $30. Let's call this $50, right? Assuming that volatility is going to pick up a little bit. At 53, we're at about $50. Okay. If our max allowable loss in dollar terms is $1,000 per trade, divide that by 50, 1,000 divided by 50, our size for this trade is 20 contracts. Right? So if we do 20 contracts, we get to 53, our P&L is going to be down about, let's take volatility up a bit, right? At 53, right, we're down about $1,000. That's our max allowable loss per trade. So that's how I would size this trade, right? You figure out your potential loss for 1 contract, and then based on your max allowable loss in dollar terms, you divide that by a loss per 1 contract, and that will give you the max of number of contracts. So does that mean that you should go in 20 contracts right away? Maybe, maybe not, right? Maybe you do 10 with intention to possibly add another 10 when you're down halfway to your stop or something like that, right? You can scale in and out of this trade any way that works for you. There isn't just one way to do it. This is just an example of how you can possibly scale into this trade, or how you decide what your max number of contracts for this trade would be. So again, we're looking at, let's say, 20 contracts, right? This will put us in a net negative 73 delta. Do we want to be net negative 73 delta? Maybe not. So maybe we'll do minus 20 on the puts and minus 15 on the calls. What does that do? That puts us at a delta plus 23, right? If that's enough, great. If not, well, maybe we'll do 20 by 17. That gets us at a slight negative. You can move this around and get to where you want to go, right? Based on what works best for you, right? But the idea here is that the underlying is going to trade inside of the range that is currently being priced in. And then if we get to about 50% of max profit, 60% of max profit in about, 50% of the time, right? Let's say 18 days goes by, which, by the way, next 12 or so days are going to be, the holiday trading, Volumes are light. I don't expect a lot. So I think that a lot of it is already being priced in. But I think that, this is not free money, but this is the hardest free money that you're going to see. Right? You put this trade on. Hopefully nothing blows up over the next 2 weeks. So let's say by the beginning of the year, right, volatility continues to come out, and then maybe we're somewhere inside of 54 and 56. And we should be able to reach close to 50% of max potential profit. And then you have to decide for yourself, what do you want to do? Do you want to continue to stay in the range-bound trade, or do you want to maybe roll out for more time and capture more premium? Right? And then you may want to figure out, if we're at 54 or if we're at 56 and now we're net negative delta, right? We'll be negative 385 delta. Your trade is profitable. You kind of want to decide, all right, if I'm going to move on from this trade and set up the new trade, how do I want to align my deltas? Do I want to be positive, negative, neutral delta, right? What's my contract, my max number of contracts, right? What's my max size? Am I going in all in at once, or am I going to scale in and scale out, right? So there's a lot to think about. There's a lot to plan for, right? So, but that's the idea for XLF. I see your messages, guys. I also got a fill for the Bear Trap for a $2 credit. As you see, the market pulled back just a little bit, and we got a fill. Rich says harder to figure out when uneven number of calls and puts. Yeah, Rich, I think you're right. It's kind of hard to figure it out, but you know what? If you are using some kind of analytical tool that kind of, and especially if you can put your mouse over certain price points, it'll tell you your P&L at that given price point. You can figure out, right, how many contracts on which side you want to place, and that's kind of how I do it. To try to figure out, 20 by 16 in your head where the risk is. It's a little tricky, so I just prefer to do it on a visual tool such as Option Explorer. But if you are using Thinkorswim, that works as well. Rich is also saying, do we only focus on the loss at the low side? No, on the upside as well, right? If we start to break out and we move towards 57, well, what's my position at 57? Well, at 57, assuming that volatility isn't going to explode at around 57 for this XLF example, our loss is at around $800. If our max allowable loss is $1,000 per trade, right? We're not quite there, but we're very close to it. So we need to start to make plans to potentially exit out of this trade. I do not think that rolling the untested side, as we're often told, is the way to do it. I am not a subscriber to that idea. Very simple. Not because it's wrong for me. What's going to happen is after we get a jam higher, right, and our calls are under pressure, we decide to roll the untested side. Well, what's going to happen is we're moving downside risk closer to at the money. And sure, if the underlying continues higher, rolling the untested put side is beneficial, so to speak. But if we roll to 57, right, consolidate a little bit, and then we revert back to the mean, wherever that mean may be, right, we see sometimes we get these run-ups and then we get these dumps, right? If that happens, what's going to happen is we run to 57, you roll the untested side, the underlying rolls over, and now your puts are tested. What are you going to do then? You're going to now roll your calls in. You will potentially end up with a straddle, or you may even have to go inverted. For what? For the sake of being right? If you wanted to do a straddle, just do a straddle. You know what I'm saying? That's why I don't think that rolling the untested side, it's inviting more problems than I need. All right, let's. I hope this is clear, guys. I hope that you're getting something from this discussion, because there are definitely many ways we can slice this. And as always, you've got million different options. URA This one started as a Jade Lizard short 50s, and then the calls have already long gone. So now we're dealing with an underlying that is currently in a downtrend. As you can see, we're making very clear lower highs, lower lows, except a couple of days ago we're pushing lower, and then now we have a couple of up days. Yesterday, this underlying was up just over 1 standard deviation. Today, it is up about 1.6 standard deviation. Does it mean this downtrend is over? No, but we are potentially trying to make a higher low relative to the low from November 21st. We're also testing 8 and 21 EMAs, which is kind of positive and maybe an early signal that this trend may be changing. We do have a declining 50-day SMA, which could potentially act as resistance. So this trade is not out of the woods just yet. However, what are our options here? So we have the in-the-money short 50s that are currently acting as, or this risk graph kind of looks like a long stock short 50 call, right? This is a synthetic covered call position with 14 days to go. The risk of getting assigned on these short in-the-money puts is not as great. There's still $2.73 worth of extrinsic value. What I was considering for this trade, just to bringing a little bit more premium here and potentially move our downside break even down a little bit more, go out to maybe a 35-day until expiration cycle and look to sell a slightly out of the money call credit spread. So like a 47, I don't know, 52, 47.52. And what that will do, this will put us in like this weird looking risk graph, right? This green graph is the proposed risk graph at expiration. Now we have two different expirations going now, right? We would have January 2nd and January 23rd. So for right now, right, the best case scenario, if we were to sell this call credit spread for $1, right, we'll take in an extra $500 here. And what would happen is to the downside, right, we still have to deal with an in-the-money put, which is a synthetic for a covered call position. And then if we are moving to the downside, this call credit spread is going to lose some of its value. So it's currently going for about $1. Maybe it'll lose 50 cents or 60 cents, and we can cover, and we're just using that to bringing a little bit more premium to potentially reduce our cost basis. Or if we jam higher and now this call credit spread is in trouble, well, if our short 50 in the money put expires worthless, we'll end up in a position where our call credit spread is in trouble, but we don't have upside risk because the puts that we have been selling so far we have collected more than enough to offset any of the upside risk. So worst case, if the underlying jams higher, we'll end up with a small $500 potential profit on January 23rd. And if we're somewhere below 46, right, this kind of has to work out perfectly. What we would need is a move higher over 50 in the next 2 weeks. Maybe we'll make a lower high and then potentially roll back over, and we end up with this short call spread with 35 days to go, and that's where this trade will max out on its profit. Right? So we're by selling this call credit spread, we're not really taking on a ton of upside risk. We're just bringing in a $500 credit to help this position out, right? We are in a synthetic covered call position. So I don't hate this adjustment. We're bringing in about $1 credit for a 47.52. This is a 5-wide call credit spread for $1, and it's 35 days out. So near term, we have to deal with an in the money 50 put. If this put expires worthless, that's first positive that could potentially happen to this trade. Then we would be looking for a pullback. If it happens, we'll max out on the potential profit, right? Under 47. And if the underlying continues higher, if we don't pull back, we don't really have to worry about, we still would need to close out this call credit spread because both options would be in the money and we don't want to deal with potential assignments, but we know that at that point we would not have any upside risk, so we don't really have to worry about the underlying going to the moon. All right, so that's one idea. I think this, I've looked at a few different scenarios and I think I like this one the best. All right, we're almost done. What else we got? URA. We are holding the Magnificent Seven. This is a long-term leap with a short out-of-the-money call. The short out-of-the-money call is at 70. The underlying is at 67.02. The short out-of-the-money call is currently trading with 28 days until expiration for about 50 cents. We sold it for 75 cents. So I think we'll hold it for at least another 2 weeks. Best case, right? We move slowly higher and then we'll potentially look to sell another covered call against the leap, right? The reason why we're selling calls against the leap, it just helps to reduce cost basis of the January 15th 40 call that we're long with delta of 93, right? So net, we're still positive delta, so we don't really have to worry about upside risk. There isn't any, right? If we blow up through 70 to the upside, not a big deal. We'll just have to figure out if we can roll the 70 out for a credit. If we can't do it for a credit, and if there is a debit, I'm going to introduce you to a new concept that most gurus haven't discovered yet, or maybe they're just keeping it a secret and not talking about it. If we are rolling our short calls for a debit, who's going to cover the debit? Me? No. We're going to maybe roll the long 40 call up to 45, right? To 45. Here's a scenario. Let's just assume, right? I'm just going to use these options to keep it very simple. And let's assume I'm buying back this 70 call for 50 cents. And let's assume that I need to roll it out in time, but I can't do it for a credit. I'm rolling it for a debit. I'm just going to use the 69.5. We wouldn't be rolling it down. We'll be rolling it up and out. But here I'm using the 69.5 because it is higher priced than the 70 that I'm buying, right? So I'm buying something. Sorry, I screwed that up. I'm buying something for 50 cents, right? And I'm selling something for, let's see, for 60 cents. Okay. Where's my 60 cent? Let's use 75 cents. So I'm buying to close 50 cents. That's a 50 cent debit. And then I want to collect a credit that is smaller than this 50 cent debit. So let's assume we'll go with the 74 for 37.5 cents. Right. So this is a net debit roll. Right. I have to add $15 to this roll to cover this roll. Well, I don't want to pay a debit, right? Because I'm extending my duration. Sure, I'm getting a little bit more room to the upside, but I'm not going to pay a debit to stay in the trade longer. Because why? The downside, that's where the main risk is, and the downside risk is real. Maybe you don't believe that, Magnificent Seven is going to go down 20%, but we don't know that, right? So why would I extend the risk that I'm already taking and I have to pay for it? No thanks. So what I would do, in order to cover this debit, right? Where is that money going to come from? Well, I'm long a I'm long a January 15th. I believe this is 2027. January 15th, 2027. This is a 40 call, right? I'm long this call. I'm going to have to sell it and open, right? I'm selling it for $29.45 and I'm buying a call for $25.50, realizing a net credit about $4, right? Plus one. Oops. Yeah. So now what's going to happen is I have a net credit for this adjustment. So I'm adjusting my near-term risk, right? If my 70 call is now in the money, I'm trying to roll it out for more time and up, right? To give myself room to more upside. This is a debit roll. I'm also going to shift my leap higher, collect a credit that will cover the cost of this roll. And I will eventually end up with more room to the upside, and I will reduce my downside risk by about $400. Right? How does that change my delta? Well, my delta is going to be slightly more positive, right? If you want to stay long in the trade, this is a decent way to do it, right? We're selling the leap, we're buying a leap closer to at the money, we're collecting a credit, and we're spending some of that credit to fix our near-term problem, which is the short call. All right, that's one way I think this makes the most sense. And then if, let's say, right, the underlying runs up a little bit more and then it starts to roll on you, then you say, oh crap, now what? Well, you can always move your short calls that you're holding against your long leap and move it down for more credit. You will cut your net delta, which it's still not going to fix your downside potential problem, but it's going to rebalance your net delta. And if there is a near-term pullback, by rolling your calls from out of the money to maybe at the money, will help you remove some of the net delta and potentially reduce the size of a drawdown in the near term. All right. So yes, we're talking about, several moving parts at once, and it's not a beginner level thinking. It's slightly more advanced. And, the more you think about it, the more you use some kind of visual tool to kind of see, what if I roll this to here and that to there, back and forth, and kind of see what your risk graphs will look like. I promise you, you are going to be better off in the long term as an options trader. Right? Don't train yourself following somebody. Hopefully they've done their due diligence, or, hopefully your risk profile aligns with theirs. Learn to think for yourself. The best way to do it is, the ass in the seat time. You have to sit down. You have to look at stuff. You have to analyze things. You have to, build out different scenarios and see what works best for you. All right. I know we went a little bit over the 1 hour planned. Hopefully you guys got some good ideas, and hopefully we covered all positions that we have that are part of the triple income trade portfolio. If you have any questions, you can always find me on Discord. Do not hesitate to ask questions. Otherwise, I definitely appreciate your time. Thanks for tuning in. Have a good weekend. Until next time, guys. Bye-bye.